Before we begin, you should understand that this video is made for educational purposes only. If you decide to use the trading techniques presented in here, do it at your own risk. In this course, you are going to learn the origin and a brief historical context in which the Dow theory was born and the 6 fundamental principles behind the theory. Within the 6 fundamental principles, you'll learn the 3 types of price movements, how to identify a trend change, how to determine if the trend is going to continue, how to use different stock averages to confirm the long-term trend, how to use volume to confirm price direction, the 3 different phases of bull and bear markets, and last but not least, you are going to learn the advantages and disadvantages of the theory as well. Before we move on to the actual rules and guidelines of the Dow theory, we should quickly remember the context in which it was born. The man behind the theory that we're going to study today was a journalist called Charles Dow, born in 1851 in New York. Charles Dow was very interested in the understanding of how markets behaved. In conjunction with Edward Jones and Charles Bergstrasser, Charles Dow created the Dow Jones and Company, the financial publishing firm responsible for the Wall Street Journal. Back then, many of the stocks had an overly chaotic movement because of low liquidity and the absence of strong regulation, which facilitated stock manipulation. For that reason, Charles Dow had the idea of creating stock averages, which is nothing more than the sum of similar stock prices divided by the number of stocks being summed. This gave an overall feeling of similar stocks while smoothing out the erratic movement of individual stocks. These averages were published in the Wall Street Journal and they are still widely used today. The Dow Jones Industrial Average is the average of the 30 largest and most important American companies. We are talking about companies like Apple, Coca-Cola, Nike, Walt Disney, Visa, Microsoft, and others. In this image, we can see the weekly chart of the Dow Jones Industrial Average since the 1950s. There are other averages like the Dow Jones Transportation Average and the Dow Jones Utility Average also. Charles Dow's ideas of how the market behaved were later developed by William P. Hamilton after Charles Dow passed away in 1902. The Dow theory is based on investor psychology and it is supported by chart analysis. The theory outlines 6 fundamental principles that will theoretically allow the trader or investor to ride the long-term trends of the market. The theory provides rules and guidelines to identify reversal signals along with confirmation of these signals, and the identification of the different phases of bull and bear markets based on basic investor psychology. The best way of understanding the theory is to go through each of the 6 fundamental principles one by one while analyzing their properties. The first principle claims that the average discounts everything except what Charles Dow used to call acts of God. Even though this is a short principle, we must apprehend what Charles Dow meant by the term discount and the expression acts of God. What he meant by discounting is that the stock averages will smooth out the chaotic movement of individual stocks. In other words, the stock averages will have a more stable movement in comparison to individual stocks. In more practical terms, the Dow Jones Industrial Average, for example, will have a smoother price action than looking at the individual stocks that compose the average. There is a reason for that, and it relates to the concept of systematic and unsystematic risk in the financial markets. Individual stocks are subjected to the risk of the overall economy being affected, and beyond that, they are subjected to the risk of bad internal management, meaning that the economy can be going well, but if the company has a bad administration or suffers some sort of specific negative event, its stock price will tumble. This internal risk associated with the company is called unsystematic risk, also known as diversifiable risk. The risk associated with the economy as a whole is called systematic risk. The concept of stock averages attenuates the unsystematic risk of individual stocks, very much like a portfolio of stocks diversifies the unsystematic risk for buy and holders. For example, if one of the companies that compose the Dow Jones Industrial Average suffers some sort of negative impact, and that causes the stock price to fall while the average is going up, the reflection of that movement in the average will be minimal since one company represents only a small fraction of the average. As a result, the average is more of a reflection of the economy as a whole, or at least a sector, while individual stocks are a reflection of individual companies and the economy as a whole. Let's create a hypothetical stock average using 5 hypothetical stocks. We have stocks A, B, C, D, and E, and we are going to create an average of these 5 stocks. Notice that all of them are rising, but they are different from one another. The average will obviously reflect that. Remember that we calculate the average by summing the stock prices from the 5 companies and then divide this number by the number of stocks being summed, which is 5 in this case. The graph title Average 1 is the resulting average of these 5 hypothetical stocks. Now imagine that stock E fell instead. If we compute the new average, we'll observe that it still rises because all of the other stocks are rising, and stock E only represents 1/5 of the average. In this example, we are only using 5 stocks. The Dow Jones Industrial Average uses 30 stocks, so the effect of each stock in the average is much less powerful. That's the advantage of using an average. It smooths out the noise created by stocks that are going in the opposite direction of the market in general. That's what Charles Dow meant by the phrase that stock averages discount everything. The expression acts of God relates to events associated with the systematic risk or the economy as a whole. These are the types of events that affect the economy in general, and therefore all stocks in the average simultaneously. In summary, when analyzing stock averages, we'll be looking at broader sectors of the economy and not individual stocks. The second principle relates to the classification of trends. But before we understand that, we must learn how the Dow theory classifies price movements. There are 3 types of price movements according to the theory. The primary trend, which is the long-term trend, the secondary swings, which are the mid-term movements that happen within the primary trend, and the daily fluctuations, which are the short-term movements that happen within the secondary swings in the primary trend. There is a useful analogy that ties these 3 movements together. The primary trend is analogous to the ocean tides. In other words, very slow but very broad movements. The secondary swings are like waves, so they happen within tides. They are smaller in size and shorter in time duration, even though there is quite a bit of variation in the size of waves. The daily fluctuations are analogous to the ripples, which are tiny variations compared to the tides, for example. In this illustration, we have the primary trend or tide being represented in green. This is the slow and broad movement of the market. In red, we have the secondary swings or waves, which happen more frequently within the tides. In blue, we have the daily fluctuations or ripples. These are small variations that happen within secondary swings in the primary trend. The second principle of the Dow theory tells us that when the primary trend shows rising prices, we have what's called a bull market. When the primary trend shows falling prices, we have what's called a bear market. The use of the terms bull and bear is a simple analogy to the fact that bulls throw their prey up when they attack, and bears throw their prey down when they attack. Traders are obviously interested in knowing when a bull market reverses into a bear market and when a bear market reverses into a bull market. The Dow theory provides 2 elements for detecting a reversal. The first is a breakout signal, which is a sign that a significant reversal might occur, and the second is a confirmation of that signal. The reversal signal for a bull market happens when the market is going down and a swing high is broken. The confirmation happens when the market hits a 20% retracement from the market low. For example, if the market low is 10,000, the 20% retracement in the case of a bullish reversal will be 10,000 plus 20% of that, which equals 12,000. The reversal signal for a bear market happens when the market is going up and a swing low is broken. The confirmation happens when the market hits a 20% retracement from the market high. For example, if the market high is 10,000, the 20% retracement in the case of a bearish reversal will be at 10,000 minus 20% of that, which equals 8,000. Notice that this has nothing to do with Fibonacci retracements, which are relative. The 20% retracement confirmation from the Dow theory relates to the absolute price value. Later in the course, we'll see that identifying the reversal signal is not as easy as it looks because secondary swings vary a lot in size and time duration. and the market will often produce false breakouts due to a condition called expanding pivot formation. We'll also observe some important problems with the reversal signals and reversal confirmations. Bull and bear markets have 3 distinct phases each. Let's begin first by looking at the different phases of a bull market. The first phase of a bull market is called accumulation. In this phase, investors and traders tend to carefully choose the most discounted stocks to buy. In technical terms, an accumulation is a sideways market that happens before an uptrend or a bull market. If we look at volume, the accumulation phase is characterized by a sideways price movement while volume gradually rises. If you want to learn more about volume trading, check the Ultimate Beginner's Guide to Volume Trading in the YouTube card. In the second phase of the bull market, which is called increasing volume, both price action and volume start to rise. There's an overall sense of optimism in relation to the economy, and secondary stocks also become an interesting choice for buyers. If the trader looks at a cumulative volume indicator like the OBV, for example, both volume and price will rise, indicating a strong bullish movement. The third phase of a bull market is called final explosive move. This phase is characterized by an overly optimistic bias about how much further stocks will rise. People usually borrow money to invest in stocks, and the valuation of companies is ignored. Excessive speculation and greed tend to occur in this third phase of a bull market. In this final stage, we can usually observe a more significant spike in volume. When it comes to bear markets, there are also 3 distinct phases. The first phase is called distribution, and its main characteristic is that professional investors and traders are starting to sell while amateur investors and traders are still thinking it's a good idea to buy. These are the traders who enter the bull market too late, which facilitate the transfer of ownership of overbought stocks from professional investors to amateur investors. The second phase of a bear market is called panic, which is marked by the amateur investors and traders realizing they bought stocks at unreasonably high prices, so now they are in an urge to liquidate their positions before they lose too much capital. In general terms, prices fall faster than what they rise because panic is a stronger feeling than optimism, and it creates more sense of urgency. The third phase is called lack of buying interest. Even after the market has significantly dropped, and most of the companies are extremely undervalued, there is still a sense of pessimism in most traders and investors. There is a general fear that prices will not stop falling. The third principle in the Dow theory is called principle of confirmation. This principle states that for a real bull or bear market to exist, at least 2 of the 3 Dow Jones averages must be going in the same direction. The 3 averages are the industrial, transportation, and utility. Each average reflects a different sector of the economy. The goal of this rule is to assure that the trend is a result from a macroeconomic phenomenon, and not just a trend contained within a specific sector of the economy. If the 3 averages are going in the same direction, or at least 2 of the 3 averages are going in the same direction as the theory suggests, it's a good indication that the economy as a whole is going in the same direction. Notice that the third principle of confirmation, in alignment with the second principle of trend identification, gives a framework to analyze if there is a reversal signal and a confirmation in the financial markets as a whole. The fourth principle in the Dow theory is that volume confirms the trend. As a general guideline, volume increases at the peak of a bull market and at the panic phase of a bear market. Once again, for a more detailed study of volume, check out the Ultimate Beginner's Guide to Volume Trading in the video card. In basic terms, the idea that volume confirms price movement suggests that high volume confirms the strength of the price movement and low volume disproves it. For example, if price is rising and volume is increasing, the price movement is confirmed. If price is rising and volume is flat or even declining, it means that the upward price move might not be as strong as it seems because there is not much volume to sustain it. The same is also true for downward movements as well. If price is falling and volume is rising, the downward price movement is confirmed. If price is falling and volume is flat or declining, it means that the downward price move is not as strong as it seems to be, since there is not much volume to back it